Okay, we are recording.
Ready? All right. Our fraud case is over Farmore by Joe Fritz and Jake Peterson. Background, Farmore was started in 1982 by Michael Mickey Monis and David Shapira. It was a deep discount retail chain. It was new in the rapidly growing market for deep discount retail chains. These are stores where they buy strictly on deal from their manufacturers, and they settle for limited qualities in exchange for discounts from 12 to 20%. They made up for these lean margins with high volume. They usually sell 6 to 7 times more per area than their conventional stores. As I said, it was started by David Shapiro, who was named the CEO, and Michael Monis, who was the president. It was an affiliate of Giant Eagle, Inc., which was at the start owned 50% of Farmore. And Giant Eagle was actually owned by the Shapiro family, and Monis worked as a VP for Tamarkin, which was acquired by Giant Eagle in 1981, right before they started. And then by 1989, sales had reached $1 billion, and they had over 162 stores. So they quickly became the key player in the market. The key players of our case are obviously Michael Monis. He was not your typical president for a drugstore. He was known for traveling around in a white limousine, often with an entourage of his friends and family. He was known for buying his friends' stuff, lots of nice stuff. He was in the process of building a new 18,000 square foot house that was equipped with a basketball court, really nice. He was also one of the initial investors in the Colorado Rockies, and he obviously had a huge love for sports, spent a lot of time and money on sports. And he was also known for frequently going on trips to Las Vegas, where he would have a suite waiting for him at the Caesars Palace. Next was David Shapiro, who, as I said, is the CEO. He was known for kind of being the opposite of Monis. He was set to fit right in with the stuffy drugstore environment industry. Next was Patrick Finn, who was the CFO and pretty much Monis' partner in the whole thing. And last is Coopers and Lyman, who were the auditors for Farmore over the time of the fraud, and they later merged with Pricewaterhouse in '98. And now Jake's going to talk to you about the auditors and what happened.
Now, he talked about Michael Mickey Monis as being liking to spend money, really big into sports. He was 5'9" himself, and he was really into basketball, and he wanted to start. His dream was always to play in the NBA. And obviously, at his height and his skill level, he couldn't. But with the amount of money that he had, he really wanted to create a league where people could. And this league eventually led to the fraud, part of the fraud. But this league was considered a minor professional league. Think of it as like what the D League is now. This was before the D League existed. And it was founded in November of 1987. And it actually had height restrictions. So in the league, the tallest a person could be would be 6'5". And with this, change the pace of the game, had everything going much faster, little defense, more athletic. It just gave people a chance to play and kind of put on their skills for display. Now, they said to be average 3,240 fans per game, but this was later found to be really exaggerated, and they were not actually making much money. The $10 million is what they had lost over the 4 years of the existence of the league. So it was very unsuccessful. And Monis, to keep the league afloat, he actually invested 60%, or he had equity investment of 60% of 10 teams within the league. And so he shared the profits and the losses, but since it really only lost money, he had to share in all the losses. And with this, to keep funding, there was an embezzlement. And he had a check writing machine at Farmore, which would just cover any expense for the league. So anytime he needed money, he would just go to Farmore and ask for more money. And he would have checks to cover every single expenses. He always had the players in the best suites possible, everything that they could imagine. Like, he kind of treated it like it was a professional league. And this was kind of like the start of the embezzlement and the fraud for Monis, because of his lifestyle of wanting to spend as much money as possible. The league eventually folded in 1992. Now the fraud, as Joe talked about, they're a deep discount retail chain, so they live on small margins, and their number one competitor was Walmart, and Monis had a really competitive edge in him, and he really wanted to be in first place. And so what he would do is he tried to cut the margins down as much as possible, and all he had to do was just keep getting as much inventory as possible and cutting the price down, so he could have these smaller margins and have cheaper products than Walmart. In 1988 was the first year they found that they had actually had a pre-tax loss over the year. And so when Monis found this out, he talked to his CFO, Patrick Finn, and they needed to come up with a way to have creative accounting techniques so that they would show a profit. So the members that were initially involved were Mickey Monis, Patrick Finn, the CFO, the Vice President of Marketing, the Director of Accounting, the Controller, and then there were other members up in the higher management, which was involved in the fraud. And because of this fraud showing a profit, it led to, after the years of 1988, $1.14 billion being invested in this company. And the main investors were Westinghouse Credit Corp or Sears Roebuck and Company. And these banks and high investors invested approximately $1.14 billion in the company, which they would eventually lose. The main idea of the fraud was to understate the cost of goods sold, and which would then overstate inventory and income, which would lead to a profit. And one of the first ways they did this was through the TAMCO settlement. TAMCO was one of their main suppliers of inventory, and in the year 1988, TAMCO was shipping partial orders to them and still billing them for full orders, which was costing them money. And this was actually just the beginning of the fraud. What they realized they could do is they could overstate inventory to help keep them having a net income. So what the initial settlement was $7 million TAMCO had to owe, had to pay Farmore for the inventory that they did not ship. And through this, they actually had that profit of $2 million to offset that $5 million loss. And this wasn't shown on the financial statements besides just the footnote, because it was a related party transaction. And so without that footnote, or without them even saying anything, it would have shown that they lost $5 million. And along with the fraud was found to be the $10 million embezzlement by Mickey Monis. The World Basketball League, that house he was building, as well as engagement rings, just anything that he could buy, he was kind of stealing money from the company. So the fraud lists 7 key factors to why the fraud was so successful over the 6 years. The first one being the lack of adequate management information systems. Now, with so many people at the top, they were able to control how the management information systems work within the company, and they did a great job of making sure that these were inadequate. It was said to be wrong on many levels. They were just not up to date. They weren't functioning the way that they should be. And anytime people would mention it, they would mention it to upper management, but those people were always involved with the fraud, so they didn't get in any trouble. The next one is poor internal controls. The check writing machine, along with another bank account. The fraud team had 2 bank accounts in their power that they could just keep writing checks for, or from whenever they wanted. And they were able to bypass the accounts payable of the company, and no one knew about this besides the people that were involved in the fraud. The third one is the hands-off management style of David Shapiro, the CEO. Now, he was affiliated with Giant Eagle. His family owned Giant Eagle, and so he didn't spend a whole lot of time with Farmore. And then whenever anyone would bring up to him, there were multiple occasions where people within the organization bring up to him how Monis was acting funny, there had to be something off with Farmore with how they were still making money with how they did their operations. He would kind of just distance himself from it, just didn't really want to deal with the problem. The fourth reason is the inadequate internal audit function. This might be one of the biggest ones. Mickey Monis was actually on the audit committee for the company, which obviously it should not have happened with independence. And they actually had other auditors on there. So through this, they were able to understand what the internal auditors were looking at, and they could either eliminate the function or change what they were about to look at, so it looked like it was legitimate instead of fraudulent. Collusion among upper management. There was a lot of members within upper management which had a part in the fraud, and this made it so much easier. Instead of just 2 members within the fraud, 2 members in the organization putting the fraud, there were multiple members. So there was a lot of help between the people in the fraud to make sure that this continued to be fraud. the knowledge of audit procedures. Within the members of the fraud team, they actually had multiple members be previous auditors, and because of this, they knew how auditors acted, and they actually had at least one member formerly on the Coopers and Lybrand auditing team, so they knew exactly what they were going to look for. They knew their audit procedures, so they were able to manipulate how they presented statements to them because they knew exactly what they were looking for. The last one is the related parties. Dave Shapira and Mickey Monis, they actually had 91 related parties with their company, which helped them spread their business around. And because of this, it was really hard to keep up with where the fraud is happening because of 91 related parties. So how it worked in more detail. The general ledger contains the journal entries to get the inventory to the correct amount. And they would credit inventory for the correct amount, but instead of debiting cost of goods sold or an expense account that was accurate, they would debit these phony accounts such as accrued inventory or allocate inventory or cookies. And these were always obvious account names that which did not exist. And these bucket accounts were then later zeroed because they knew that the auditors were not looking for zero balance accounts. So they would zero these accounts and spread it among the stores. So they would spread the losses between 129 stores, and this would inflate their inventory, inflate their assets. They would expense them in there as assets, and this would show them a profit while eliminating the loss of the cost of goods sold. They operated, the main reason this could happen was because of the gross profit margins. With being a deep discount retail chain, they said that their objective was to have 15.5% profit. And when the auditors would go in and look, they'd see between 16.1 and 17.7 actual profit. And they thought, okay, this is just a little overinflated. The price sensitive, the lower items, which are more, the cheaper items where they were making a margin, were not in these stores. But actually, they were able to manipulate it, and so the gross profit margins looked higher. But really, the profit margins were well below 15.5. I mean, they were having a loss ever since 1988. They never actually made a profit. Another way that they could do this is an inventory spike. There was a difference between the inventory date when they had the inventory and the balance sheet date. And in between these 2 days, they would have an inventory spike. They would claim it was because of the July 4th holiday. Their fiscal year ended June 30th, so they said that they were just having a lot of more inventory for this time, but it was really just them creating false inventory. They were actually caught by a travel agent. So as Monis had all these checks and paid for everything just through these checks, what he did was he actually paid a travel agent expenses that were not by Farmar, but he paid with a Farmar check. And the travel agent's landlord actually happened to be an investor in Farmar. So he told his landlord about this check, and this person contacted Dave Shapira, which led to the fraud being discovered by Dave Shapira, and he eventually, on August 4th of 1992, went to the public and stated how there was a massive fraud with Farmar. So now a lot of people would ask, where were the auditors? I'm just going to be going into detail about what the auditors were doing at the time. Joe's going to go into more detail about how this was wrong. So Coopers and Lybrand were the lowest bidders for Farmar. They had the lowest cost, which is part of the reason why Farmar chose them. And Greg Finnerty was the partner in charge, and he even said that Farmar was a high risk. They had hard to reconcile accounting procedures, and so, but he kept going on with this because he was kind of passed over within the company about profit sharing, and so he was hungry for more business. And through Mickey Monis, he was actually able to find 23 other members which paid him services, and so he made roughly $900,000 through this. And Infinity has been previously criticized on audits for being over budget. So part of this was he had to keep the budgets down, so he kind of cut corners on this specific budget and on this audit of Farmar because he didn't really want to go over budget and keep getting criticized, so he would cut corners, cut things out of the audit of Farmar. Now, of the 129 stores in the 1988 audit, they chose to visit 4 of them. They even actually told Farmar and Mickey Monis which 4 stores they were going to be visiting. So obviously this is wrong because they were able to inflate the inventory, put the items there that they wanted to have. And instead of going in and actually counting the inventory themselves, they had an outside inventory source go in there and count the inventory, and they just kind of took their word for it. They tagged along, but they never physically counted the inventory themselves. They just kind of accepted what the outside inventory source was telling them. And like I said, the pricing of inventory, they would have inventory items there that were above the 15.5 projected profit margin, and they did this through knowing which 4 stores were going to happen. If they had the actual inventory with the price-sensitive items, there was no way that the 15.5%, which was projected, would be shown. within inventory compilation packets, they would receive these packets and they would contain the physical counts, the retail pricing, the inventory and cost, and the cost of goods sold. And within here, they would only examine 1 to extent and 4 to a lesser extent. So the one that they examined fully was obviously fraudulent, but they missed out on so many opportunities. They didn't ever question these cookies accounts, these fake debit entries. And they made sure to just kind of skip it and go along because they were on a budget, they were running out of time. So they just really kind of skipped over everything, skipped over obvious fraudulent information just to get the job done. And eventually, the roll forward, this was the time between the budget and the inventory time, and they fully accepted what Farmore stated, what Mickey Monis told them, how they were just an inventory spike because they stated that they lowered inventory for the physical count to make it easier, and then the second one was the July 4th with the holiday coming up, then they had a huge spike in inventory. And they bought it, they didn't even check it, they didn't ask any other questions, they just bought everything that Mickey Monis told them because he was providing more services or making him more money. And through a court case, they were found guilty under state and federal law in February 14th of 1996.
All right, so now I'll talk about the incentives, the opportunity and rationalization that Manny Monis and his team had behind this. First, he wanted to maintain his extravagant lifestyle of how he made trips to Vegas all the time. He loved sports. A lot of people said that he mainly just wanted to get money out of Farmore so he could continue his love of sports. So yeah, and like Jake said, he had all the losses from the World Basketball League that he was trying to cover because he did own a part of every team. And I saw a thing that said that they were averaging up to $13,000 in losses for every game they had. So he needed a way to cover that up. The opportunity, obviously, they were all members of higher management. So they colluded together, which made it easier to get around the auditors. And they knew the auditors as well, so they knew what stores they were going to go to and what procedures they'd be doing, so they knew how to get around it. The rationalization, Monis told his team that it'd be fixed in the long term. He kind of told them it was only a temporary thing, because I guess he thought his basketball league would take off and he wouldn't need more money. But yeah, so I think he kind of thought he could do it as long as he wanted, but he just got everyone to go with him, saying that it'd be fixed in the long term. So like Jake said, some of the red flags that the auditors probably should have caught, even though they might not have been in on fraud, they did act with negligence when they were doing the audits. Some of the things they should have looked more into were, first of all, Monis' extravagant lifestyle, like I said, partying, obsession with sports, his large losses in the basketball league, his buying stuff for his friends, all of it together didn't really fit in with Farmore and the rest of the company. The related party transactions, like I said, there was a web of 91 companies that Monis and Shapira created together to do business with Farmore, and it said that they received millions from Farmore, and the complexity of this made it really hard for the auditors to find the fraudulent entries in there. Also, the price test didn't add up. Like he said, their projected gross margin was supposed to be 15.5%, and it said the average gross margins that they did when they would go do counts at the 4 stores they did was averaged from 16.1 to 17.7%. And the reason for this, they claimed, was because they didn't test the price-sensitive items. But in reality, most of the inventory was price-sensitive stuff, so that didn't add up. And then it was found out later that the gross margins were actually much lower than the 15.5. The inventory compilation packets, they included the physical counts, retail pricing, the calculation of inventory, and the cost of goods sold. And like I said, these contain those fraudulent entries. They were often made in large, even dollar amounts, and they were put in suspicious accounts like account receivables, contra, stuff like that. Stuff that should have been noticed, and the stuff that was always zeroed out after year end. Same with the general ledger. The fraud entries from the compilation packets were included in the general ledger with many other fraudulent entries. they would have large blowout entries in the last monthly general ledger to empty all the bucket accounts. And that's the same way as the other entries, they would be large, even numbers. And then also the large increases in the ending inventory balances. So they would have the roll forward from the last count date, which would have a large increase in the inventory. And like Jake also talked about, they said they would reduce the inventory for the physical counts, and then June 30th was the end of the year, so they had the 4th of July stock up right before the end. Some of the standards we thought should have applied to this was because of the characteristics of fraud, the auditors exercise professional skepticism is important considering the risk of material misstatement due to fraud. So that just kind of says they didn't really act with professional skepticism. They kind of just accepted everything that Monis and his team told them, and they kind of just went along with it. They just accepted that he was right. This one, nevertheless, the auditor may identify events or conditions that indicate incentives / pressures to perpetrate fraud, opportunities to carry out the fraud, or attitudes / rationalizations to justify fraudulent action. And this kind of relates to his basketball league that, I mean, it was known about, and they were known that they were losing money, so obviously it wasn't that hard to see that he needed a way to cover up his losses. And then the last one's the large, unexplained last-minute entries. And that says, conditions that can change or support a judgment regarding the assessment of risk are stuff like transactions that are not recorded in complete or timely manner, unappropriate or unauthorized balances, or transactions, and last-minute adjusting entries that significantly affect financial statements. And they had all three of those things, which didn't add up. And Jake will finish up.
Now, the case against Coopers and Lybrand, there are 38 plaintiffs against them. 38 people filed suit against Coopers and Lybrand, and 30 were able to settle out of court, but 8 wanted to go to court. And they determined that they should be sued by Section 10B of the Federal Securities Exchange Act of 1934. And this is because this was about fraud. There's an anti-fraud law. It showed they were liable for an omission of a material misstatement or material fact, or liable to what a reasonable investor would seem as knowledge that they would want to have. And this kind of goes into between business risk versus information risk. With any investment, there's going to be business risk, inherited risk of the company. But the information risk is seen to be always 100%. They should know everything about the company when they're investing in. Everything should be accurate. But since there was fraud going on within the company, the information risk was obviously there more than it should be. And they were investing in a company that was showing profits but really having losses. And part of the reason that the case against Coopers and Lybrand was because it emphasized facts. The facts included the fraud went on for a period of 6 years, and so it should have been found by then. Coopers was aware. The internal accountants never really gave them the documents they needed. They just kind of waited and installed until they would just accept a copy or just go on without it. Greg Finnerty had previously been criticized for his lack of knowledge on audits and how he would always be over budget. So with that, kind of brought to them how Coopers and Lybrand didn't really take the necessary time to finish it. And then with Mickey Monis being a source to Finnerty and the Coopers and Lybrand with more services, you could kind of show that he was just kind of helping them get money from elsewhere while being fraudulent within their own case. Now, ordinary negligence is defined as negligence where a person of reasonable care would be able to figure it out. An average person in this situation would act with reasonable care. And in an audit, this could be, if there is negligence under ordinary, it would be just lack of knowledge, lack of experience, lack of training on the job. Where gross negligence is deemed to be more reckless, lack of even slight care on an audit. So this would just be going through the audit without even care of what is going on, but just trying to finish it. Fraud is defined as the AICPA AU-C 240, which is the PCAOB 316, as anything that is intentional. So an intentional act that causes misstatement within the financial statement over the course of the audit. And so through this, fraud is more intentional, negligence is just acting without care. Along with that is recklessness. Recklessness was a word that they would use to go after these auditors of Coopers and Labyrinth. And recklessness, it goes around with gross negligence, where they just didn't act with slight care. They were just trying to fly through the audit and finish it because they knew that Mickey Monos was good for business for them. They helped them find others. They helped make them money. And so instead of it being fraud where they intentionally acted, because to this day, Farmore and Coopers and Labyrinth never stated that they were involved together, that they were just, Coopers and Labyrinth actually acted like the victim in this case, where they were just really just negligent. There wasn't fraud, but they were just negligent. So where are they now? Farmore attempted to live after the fraud was discovered. They had to lay off 16,000 people, and there were 100 store closures. And they renamed some of their stores between Farmore, RX Place, and Farmhouse. And they tried to keep business afloat, but eventually in 2002 they had to liquidate all their assets, and they ceased to exist. Michael Mickey Monos was sentenced to 19.5 years for 109 counts, and he was fined $500,000. This was also part of an obstruction of justice. He was found to have one of his friends tampering with the jury trial and actually bribing one of the jurors $50,000, and he's found guilty of that as well. But he actually had a sentence reduced to 10 years because he helped people find another fraud from his town of Youngstown, Ohio. And he's currently living in Florida. David Shapira was the chairman, CEO, and president of Giant Eagle, his family's company. Then he's later stepped away in 2013. He didn't get in any trouble for the actions that he had with Farmore because of him helping discover the fraud and not being involved in it. Patrick Finn, the CFO, was sentenced to 33 months in prison, and he actually was the main witness for the plaintiffs in the case. He testified against Monos and stated how everything that Monos was doing was wrong. And the final one, Coopers and Labyrinth, they settled claims with 8 plaintiffs from that case, undisclosed amounts, and they became PricewaterhouseCoopers in 1998. Any questions? John Starks actually was in this league. He went on to win an NBA championship, and so he was in this league along with, I think there were 3 other players that eventually went on to play in the NBA and win championships.
It's a little disturbing you know so much about the little league that wasn't really even part of the case, but.
It was a large part of what Monos wanted to do. It was his dream.
Is there any chance of reopening so I can go live out my glory in the local basketball league?
You know, I don't think he's wanting to try this again. It was such a huge failure, but maybe if you talk to him, I don't know.
What, do you guys know, like, why they named it Farmore, and I saw they named it, like, RX, and did that have to do with prescriptions?
Yeah, it had to do with drugs. Like it was a retail with drugstore, so it had to do with more prescription based.
They started out with more just the drugstore, and then they expanded to a lot more stuff, and eventually like frozen foods and everything else.
As far as like the case went, do you think there was like any big one in that like kind of broke the camel's back, so to speak, that found him guilty?
That found like Monos guilty or like.
Cooper and Labyrinth, sorry.
I think just in general, like their way they cut corners and the way they, kind of just acted with negligence. They didn't do everything. They didn't really investigate, like when there would be something that should come up as a red flag. And so I think all that just together. I think there was one big event.
I mean, their statements, their defense was very weak. They kind of basically just said like, "Oh, we tried," instead of really actually going through and doing everything that they were supposed to do.
You said they had an outside source count inventory. Like, were they in on it with Farmore? Like, they pay him off to like misstate it, or?
No, the outside source was just they hired an outside source to come in and count the inventory, and Coopers and Labyrinth just accepted this amount. And then after they accepted this amount, they actually would credit the amount counted, but then after this, they would go in and change it on the general ledger. So they weren't actually in on it.
Why do you think that this fraud was able to last for so long?
I would probably say just because of the collusion among like top management and the fact that they knew what the auditors were going to do. They knew the stores they were going to go to, and